Module 4, Cash Flow. Cash flow is a financial term that refers to the movement of cash into and out of a business or individual's financial accounts over a specific period of time. Cash flow can be positive, meaning that more cash is coming into the account than going out, or negative, indicating that more cash is going out than coming in. Future value. Future value is a financial concept that refers to the value of an investment at a specific point in the future, assuming a certain rate of return. In other words, it is the amount of money an investment will be worth at a future date if it is allowed to earn interest or grow according to a set rate. To calculate the future value of an investment, several factors need to be considered, including the initial investment amount, the rate of return, and the period over which the investment is expected to grow. The future value calculation considers the compounding effect of earning interest on the initial investment, and any accumulated interest over time. For example, suppose you invest $1,000 in a savings account that earns an annual interest rate of 5% for 5 years. The future value of this investment at the end of the 5 years can be calculated as follows. Future value equals present value times 1 plus interest rate to the power equal to the number of periods, usually years. So, future value in our case equals $1,000 times 1 plus 0.05 to the 5th power, which is future value equals $1,000 times 1.27628, for an answer of $1,276.28. So, the future value of your investment after 5 years is $1,276.28, which represents the total amount you would have at the end of the 5 years if you did not make any withdrawals, and the account continued to earn interest at the same rate. Future value is an essential concept in finance used to evaluate the potential growth of investments over time. It helps investors make informed decisions about where to allocate their resources, and it allows them to compare different investment options to determine which ones are likely to provide the highest returns. Present value. Present value is a financial concept that refers to the current value of a future sum of money discounted at a specific rate. In other words, it is the amount of money that needs to be invested today to achieve a specific future sum of money, assuming a certain rate of return. Several factors need to be considered to calculate the present value of a future sum of money, including the future value, the period over which the investment is expected to grow, and the discount rate. The present value calculation considers the time value of money, which means that the money available is worth more than the same amount in the future due to the potential for earning interest or inflation. For example, say you expect to receive $1,000 in 5 years from now. If the discount interest rate is 5%, the present value of this future sum of money can be calculated as follows. Present value equals future value divided by 1 plus the discount rate to the power of the number of periods. In our case, present value equals $1,000 divided by 1 plus 0.05 to the 5th power. So, present value equals $1,000 divided by 1.27628. Which is $782.45. So, the present value of receiving $1,000 in 5 years, discounted at a rate of 5%, is $782.45. If you were to invest $782.45 today, at a 5% rate of return, you could achieve $1,000 in 5 years. Present value is an essential concept in finance used to evaluate the worth of future investments or cash flows in today's terms. It helps investors make informed decisions about whether an investment is worth pursuing, and it allows them to compare different investment options to determine which ones are likely to provide the highest returns. Determining the discount rate. The discount rate is a financial concept used to evaluate the present value of future cash flows, and it is a percentage rate to discount future cash flows to their present value. The discount rate is usually determined by factors such as inflation rates, the risk associated with the investment, and the opportunity cost of investing in other assets. It calculates the present value of future cash flows by considering the time value of money. The time value of money refers to the principle that money available in the present is worth more than the same amount of money in the future due to the potential for earning interest or inflation. Therefore, future cash flows must be discounted by the appropriate discount rate to determine their present value. The discount rate is an essential concept in finance used to evaluate the potential profitability of investments. A higher discount rate implies a higher level of risk and, therefore, a higher expected rate of return. On the other hand, a lower discount rate implies a lower level of risk and, therefore, a lower expected rate of return. Perpetuity. A perpetuity is a financial instrument that pays a fixed amount of money at fixed intervals indefinitely or perpetually. It is an annuity with no end date and pays a fixed amount of money regularly, such as monthly or annually. The perpetuity value can be calculated using a formula that considers the interest rate, discount rate, and periodic payment amount. The formula is perpetuity value equals payment amount divided by the discount rate. For example, suppose you have a perpetuity that pays $100 every year, and the discount rate is 5%. The value of the perpetuity can be calculated as follows. Perpetuity value equals $100 divided by 0.05, for a total of $2,000. Therefore, the perpetuity is worth $2,000 and will continue to pay $100 annually, indefinitely. Perpetuities are commonly used in finance for valuation purposes, especially in the context of bond investments. They are also used for preferred stocks, certain real estate investments, and private equity deals. It is important to note that perpetuities are relatively rare in practice, as most financial instruments have a finite duration or maturity date. However, the concept of perpetuities is helpful in finance for understanding the time value of money and valuing assets, with an indefinite lifespan. When a perpetuity is expected to grow, such as when you want a payment to increase each year to cope with inflation, you need to fund it with more money initially. In the perpetuities formula, this manifests in subtracting the growth rate from the discount interest rate in the denominator. So, the modified perpetuities formula is perpetuity value equals payment amount divided by the discount rate minus the anticipated growth rate. For example, assume Clarissa wants to fund a growing perpetuity that will pay $10,000 per year to a local museum starting next year. She wants the annual amount paid to the museum to grow by 5%, and the interest rate is 9%. So, the formula for the amount she needs to fund it with would be $10,000, the initial payment, divided by the interest rate, 9%, minus the growth rate, 5%. This means $10,000 divided by a total of 4%. Since $10,000 divided by 4%, which is the same as 0.04, is $250,000, she must fund the perpetuity with $250,000.